turn to page 408.
Right.
Page 408. We need to talk about promissory notes and what is entailed in a promissory note, what makes up a promissory note, and then we want to focus on the math involved with promissory notes. Here. So we said the promissory note was the what? Promise to pay. It's the money part. It's the IOU. It's the contract between the borrower and the lender that sets up, you know, I owe you money and I agree to repay that money. It is a negotiable instrument. We've already talked about this. That note can be what? Sold to other investors. And when the note is sold, what that means is that the debt obligation goes with it. So if Bank of America makes the loan and they sell the promissory note to SunTrust, the money is now owed to SunTrust. Right? That's what we mean when we say these are negotiable. And that's not up to the borrower. The borrower doesn't take part in that transaction. It's the lender who has the ability to sell that note as they see fit. All right? So this is just the agreement to repay. We need to talk about, and these are in your book on page 409, very important. You're going to see these on a test. Some note provisions that come up. Basically, think of the promissory note, like I said, as just an IOU. Well, an IOU is a pretty simple thing. I owe you this much money. Do you think it should say how long you have to repay it?
Yes.
We call that the term. Okay? That's called the term of the note, the amount of time. Do you think it should say what the interest rate is going to be?
Yeah.
Sure, absolutely. And you also have to add what we call provisions. A provision is just sort of like a statement of how this thing is going to operate. So one of the first things that's going to be in almost any promissory note is something called an acceleration clause. When you accelerate something, you cause it to do what? Go faster. So here's what we're causing to go faster. The due date. What's the normal time period for the most common residential mortgage? 30-year term. A 30-year term, which means the borrower has how long to repay the money? 30 years. So it's not due in full for 30 years. Does that make sense for everybody? What an acceleration clause would do is allow the borrower to say, nope, I want all my money today, right now. And almost every promissory note is going to have an acceleration clause in there. Now, that doesn't mean they can just say that for no reason. There's a specific reason the borrower can declare they're owed their money right now. What do you think that is? A default. An acceleration clause in a note gives the the lender, the ability to say, you are in default. You are not paying me as you agreed to pay me, so I don't want your monthly payments. I want what? I want all of it right now. Does that make sense for everybody? This is a precursor to foreclosure. Here's the reason. If you didn't have an acceleration clause, and you got 3 months behind, and the lender sends you a note that says, okay, you're in default, we're going to foreclose on you, you could send in a check for 3 months. Could they foreclose on you at that point? No, because you're what? You're caught up. And then you get 3 more months behind, and they send you the nasty note again, and you do what? You send them 3 months. The acceleration clause allows the lender to say, I am not messing around with you anymore. You were in default, and therefore you owe us what? All of it. If they can't come up with all of it, can you foreclose? Do you see how this is a vital part of the foreclosure process? Because part of the foreclosure process is inevitably declaring the note is due right now. We are accelerating the due date to today. And the reason we're doing that is because you have gone into default. You've not paid as agreed. Go ahead, Brown.
Are they going to factor in the interest to the, that would have accrued to the term?
No, they will not. They will not. There'll be penalties and all that sort of thing as a result of the default itself, but they do not factor in the interest that would have been paid if you kept it for the full 30-year term. Okay? A prepayment penalty. What does that sound like it would do if it were there? I'm not saying it's automatically there. I'm saying if it were there, what would a prepayment penalty clause do? If you pay more, extra, or pay it off early, you would get what? A penalty. Why would lenders insert this sort of thing? Because they're not getting interest, right? If you pay it off early, they lose the interest that they anticipated getting. These used to be fairly common. They are exceptionally uncommon now. You almost never find prepayment penalties anymore. If you think about it, when was the last time you heard somebody say, oh, I can't refinance my house because I'd have to pay a penalty? You ever heard anybody say that? Wouldn't a refinance be an early payoff? Yeah. Because when you refinance, what you're doing is taking out a new loan and paying off the old one with it. That would be a prepayment, wouldn't it? Sending in an extra mortgage payment, would that trigger a prepayment penalty if you had a prepayment penalty clause in there? It would. Very rare to see these things now. Very rare. And the reason is the banks don't want them there. Because the banks want you to do what? Pay it off. They not only pay it off, but where do they make their money?
Already made it on the front end.
But where do they make it again? They want you to refinance. They don't want to give you a barrier to refinance. They want you to refinance 3 times a year if that's what you want to do. So the last thing they want to do is charge you a penalty for paying it off early, because then you wouldn't refinance it. Because they make those fees every time you refinance. Yes?
If you had this clause in, you couldn't even sell your house.
Correct. If you had a prepayment penalty, well, you could if you were willing to pay the penalty. Did everybody hear Sandy's comment? She said if your note had this clause, you couldn't even sell your house until you had finished paying off the note over its full term without paying a penalty. So you'd have to own your house for 30 years and make every payment. Otherwise, you'd have to pay a penalty, because selling your house is paying the note off early, right? Part of selling the house is paying the note off. So these are very rare. Very rare. And they are not allowed on most residential mortgages in North Carolina anyway. So there's another reason they're rare. They're not allowed. Okay? A due on sale clause. That's another one that you might see on a test. It's also called an alienation clause. It says that if you sell the property, then you must pay off the note. Period. If you sell the property, you must pay off the note. Well, that prevents us from doing one thing that we might ordinarily like to have the ability to do. Something called an assumption. How many of you have ever heard of an assumption? What do you think is happening if I assume someone's mortgage?
Taking over responsibility.
I'm taking over responsibility for it. So instead of me getting a new mortgage to purchase the property, so I'm buying a house from Nick. And not only do I want to buy the house from Nick, but I'd like to keep his mortgage and just pick up making payments on his mortgage versus taking out a new mortgage of my own. Does that make sense for everybody? Yep. Now, of course, I'm going to have to pay him the difference in cash between what I'm paying him for the house and what he owes. If he owes $150 and I'm paying him $200 for the house, I'm going to give him $50,000 in cash, and then I'm going to take over his $150,000 mortgage. Does that make sense for everybody? But why? Why would that be desirable? What do you think is probably true of Nick's mortgage that makes it so much better than one I could go get myself? I can get my own mortgage. Why would I want to take over Nick's?
Interest rate.
He's got a better interest rate. If interest rates happen to be running at 6% when I'm looking at buying his house, and he took out a loan when they were at 4.5%, which would I rather have, a 4.5% interest rate or a 6% interest rate? I'd rather take over his 4.5%. That's called an assumption. Well, an alienation clause or due on sale clause would prevent us from doing that, because what a due on sale clause says is that when the borrower sells the property, they have to do what? Pay it off. So as soon as Nick sells the property to me, what does he have to do with the loan? Pay it off. There's no way for me to assume it. Does that make sense? I can't assume his mortgage if the mortgage says he has to pay it off as soon as he sells the property. So what an alienation clause prevents is assumption. It would prevent an assumption from happening. So a loan, a note that has this in it would be a non-assumable mortgage. Some mortgages are assumable, some mortgages are not assumable. Like, for example, when we talk about FHA loans, VA loans, USDA loans, all of the government-backed loans are fully assumable mortgages. What that means is that they don't have what? They don't have alienation clauses in them. Whereas most conventional loans are not assumable, meaning they would have an alienation clause in them.
So this is to benefit the lender, not necessarily the mortgagor.
Correct. This is to benefit the lender, the mortgagee. Because why would a lender not want, for the same reason it's good for me to assume Nick's mortgage, why would a lender not want me to assume Nick's mortgage?
Because they can get you a higher interest.
They want me to borrow the money at 6% rather than take over his 4.5% note. Plus, don't they make the fees off of a new mortgage?
Right, yeah.
Right? So it is very much to the borrower's advantage to have an assumable mortgage because you may want, so I'll give you an example of how this is going to come into play. Right now we don't see anybody assuming mortgages, and the reason is that interest rates are at pretty much historic lows. There's no motivation. If I can go get a new mortgage loan at 4% interest, there's no motivation for me to assume somebody else's mortgage. Does that make sense for you guys? But say 3 years from now interest rates are 7%. And Nick just bought that house with an FHA mortgage at 4% interest. When it comes time for him to sell his house, is his house going to be more attractive to buyers because not only can they get that house, but they can get it with a 4% loan versus the other houses on the block, which they would have to take out a 7% interest rate loan. Is that going to help him sell his house? I mean, you think about how they sell cars. The biggest part of selling cars now is not the car itself. They don't spend any time when commercials talking about the car. What do they talk about? The financing. And they say, oh, we got 0% interest rates. And that attracts people to go buy that particular car because they're not paying as much. Same thing would be true for Nick selling his house down the road because the same buyer was going to have a lower house payment buying his house than the identical house beside it because they could assume his 4% interest rate mortgage because he has an assumable mortgage. That makes sense for everybody? And why is it assumable? Because it does not have an alienation clause. Yes, ma'am.
Does the bank vet
The new borrower?
borrower?
They do. So generally speaking, with any assumption, the borrower would have to qualify. They only qualify to assume the mortgage if they also qualify for a new mortgage. So they're basically vetted in the same way they would be if they were taking out a new mortgage. But if they qualify for the new, they also qualify for the assumption. Does everybody understand what she was asking? She's basically saying, can you just assume it without being checked?
So
But you can't.
if you had like really bad credit.
An assumption's not going to help.
Yeah.
It's not going to help because if you don't qualify for a new mortgage, you're also not going to qualify for the assumption.
Got it.
And so the assumption is basically at the lender's discretion. Or it'll be in the mortgage, like in their mortgage.
It's in their discretion, but they can't deny it if it's an assumable loan. Like an FHA, VA, USDA loan, if that borrower qualifies, they can assume that mortgage.
Okay.
Because the only thing that would prevent the assumption is this clause, and an FHA loan is not going to have this clause in it because it's a fully assumable loan. Go ahead, Lynn.
Let's say if you 3 months behind the payment and you can't make the payment, right? And came in and take over or something without paying you the remaining. So let's say you owe $150 left but you can't pay it off. So I'll come in, I'll take over and pay up the $150 without paying you.
So Lynn's question is, if I have a borrower who owes $150 on their note and they can't make the payment, could I come in and just essentially take over their payments? You know, assume their mortgage and not pay them any difference? Sure, if they were willing to sell the house for $150. The assumption has nothing to do with the sales price of the house. Okay, you're going to set a sales price. When Nick sells me his house, he's not going to sell it to me for what he owes. He's going to sell it to me for what he sells it to me for. I'm just going to pay him the difference between what I'm taking over in his note. So again, if he owes $150, but he's selling me the house for $200,000, how much cash do I owe him? $50,000, because it works the same way as him paying off his note. If I paid him $200,000 and he owed $150, he would immediately have to pay off the $150 and he would be left with $50, right? It's the same thing for him. The difference is I'm just paying him $50 and then I'm assuming his $150 note. And could I go out and get a second mortgage presumably for the $50 if I didn't have that cash?
Yeah.
Sure, I don't have to necessarily pay it in cash, I could borrow it separately. Okay? That help?
More of like they in, let's say heading towards like foreclosure kind of thing.
Right.
Just kind of transfer title to me, I just pay off the 3 months or 5 months debt quickly.
So again, you're trying to make an assumption related to a default, and they're not. When you assume somebody's mortgage, you are taking over the mortgage in whatever state it is. But that has nothing to do with what you're actually paying them for the property. Those are two separate numbers. If you happen to negotiate, I'm just paying you what you owe, then that's what you negotiate. But the two are not related. The two are not related. You know, they just aren't. Don't try to tie them together like that. Okay? So, we need to talk about how we break down mortgage payments. And it's called amortization. This is over in your book on page 410 going into 411. So we want to talk about some of these terms here. First of all, we're going to talk about principal and interest. So what is principal and interest? Together we call them debt service. Right? When we borrow money, we make a payment on that note every month called a debt service payment. The debt service payment is simply the interest that has accrued on that loan over the course of the last month plus some amount to pay down my principal balance. The goal of the loan is to do what with it? Pay it off. So when we make that loan payment, we're actually paying two separate components. We're paying first the interest, not principal first. You pay interest first. And then whatever is left over gets applied toward the what? The principal. The idea being here that over time, the principal will start to decline. Correct? As the principal declines, what also happens to the monthly interest that's owed? It declines as well because you only pay interest on the amount that you owe. What's not going to change every month though? The payment amount. Your payment amount is going to be set in a fixed rate mortgage. And so, if the payment stays the same, but the amount of interest you owe every month goes down, what's happening with the breakdown of that payment? More is going toward what? The principal every single month. So every month, a smaller piece of that payment is going toward interest, and a larger piece is going toward principal. Now at the beginning, what do you think the payment almost exclusively is made up of? Interest. It is laughable how little goes toward principal for those first few years. But it does catch up over time and it starts to swing. So as the principal starts to decline, the interest starts to decline, but the payment stays the same, so the balance tips at a certain point. Does that make sense? Okay? Alright? So interest is a charge for the use of borrowed money, and we call the payment of the principal and interest together the debt service. Alright? It says here that interest can be due at the end in arrears or at the beginning in advance. Here's what I want you to circle, in arrears. Because on a test, you're always going to deal with interest in arrears. When I make my February house payment, when is it? This week, right?
Yeah.
Thursday, is that right?
Yeah.
When I make my February house payment on Thursday, I am going to first be paying the interest that accrued in the month of what? January. Every single day of this month, the interest I owe has been accumulating on a daily basis. Because I pay interest for every day I owe the bank money. Does that make sense for everybody? And they build it up on a daily basis. Those charges just keep adding up, adding up, adding up until I make my February mortgage payment and I pay the interest owed down to what?
You're right.
0. And then once the interest owed is paid down to zero, whatever amount of money is left over gets applied toward my principal balance. And then we start to calculate next month's interest, but we're using that new lower principal balance. Does that make sense for everybody? Okay? That's how we handle these principal and interest payments. And we're going to do a lot of math with that here. As we said, most of the time it's payable in arrears, and it's charged on the outstanding loan balance. So, just as an example here, this is a $125,000 loan at 8.75% annual interest. How much interest is paid in the first year? Well, that's an annual interest rate. So, what do you think we would do to calculate the interest paid in the first year on that note?
Annually, 12 months?
Well, we've already got an annual rate. So what are we going to do with that annual rate? Multiply it by what? The loan balance, right? So it's going to be the loan balance times the annual interest rate. So in this case, $125,000 times 8.75% interest, and that gives us $10,937.50 in annual interest. Does that make sense? If I wanted to convert that to monthly interest, what would I do? Divide it by 12. If I wanted to convert that to daily interest, what would I do? Not 30. Because that's annual interest. I would divide by what? How many days are in the year? 360. 360 days in a year in this class. We treat every month the same. Okay? So if I wanted to get to, so just out of curiosity, what would the daily interest rate be on that note? I've got $30.38 per day. Daily interest. Everybody okay with that? See where that number comes from. All right? Remember, your annual interest can either be divided by 12 to get to monthly interest, or by 360 to get to daily interest. All right, here's an example. A lender charges 7.5% simple interest a year. If a borrower takes out a loan for $335,000, how much interest will the borrower pay in the first year? Go ahead and run that real quickly. So what are we going to do? 335 times what? 7.5%. You come up with $25,125 in interest. That's a big number, ain't it? A lot of interest. 25,125 divided by 360. That's it's only $70 a day, $69.80 a day in interest. It does add up quickly. All right, so let's take a look at this stuff. All right. First of all, I'm going to write up here on the board, and I can't remember if I put this in your formula packet or not. That's why I'm going to write it up here on the board. Remember, you can always make a T-bar out of a formula. Even if you don't know the T-bar, you can make one out of it if you know two of the things. We were multiplying what times what? And where do we put things that are multiplied? Top, bottom, or side, side? Side, side. So loan amount and what? Annual rate, annual interest rate. And what does that give us? Annual interest. Correct? Using that, if they gave you the actual interest charge and the loan amount, could you calculate the rate? Or if they gave you the interest charge and the rate, could you calculate how much somebody owes? I mean, for example, if I said, Travis is paying $14,850 in interest annually at a 5.25% rate. Could you tell me how much Travis owes on that loan?
Annual interest.
It would be annual interest divided by what? By the interest rate, right? So 14,850 divided by 5.25%. I owe $282,857. $0.14. Does that make sense for everybody? So you can do it as a T-bar as well. What I want to pass out to you now is a little sheet. Now, keep in mind when I give you something like this, you can't use this on the test, but this is not a complex thing. This is something you can draw yourself. I'm just trying to get you used to what it looks like. Does that make sense? I'm going to pass these out, and I'm going to go ahead and let you take like 3 or 4 each of them so that we can work through some of these questions. One of the things that we need to be able to do is to calculate how much money you owe after a certain number of payments. To be able to calculate a loan balance after 1 or 2 or 22 payments have been, you're not going to have to do 20, I promise. But to be able to calculate the balance after a certain number of payments have been made, we need to be able to figure out how to do that. And I find this little chart here will help you get that done. I didn't do a very good job of getting these out evenly, but. Alright. How many did I give you guys? If you got more than 3, give them back. If I have enough. Thank you.
There you go.
We should have 3.
3 is enough. I only need 3 more, so. Perfect. Teamwork. Alright. So, this little chart is something that you could make on your own when you got on the test, right? Once you get used to using it like this, it's just... So here's what I want to show you. We're going to start to break down these principal and interest payments into their components. Because what will happen is they'll give us a monthly payment, and then they will give us an interest rate, and they'll want to know how much is the payment or the balance going to be after a certain number of payments. Does that make sense for you guys? So each line is going to represent a payment. What's always going to be true? The monthly payment's always going to be what? The same. Month after month after month. So this number should always be the same. And the principal, the amount going toward the principal should do what every month? Increase. The amount going toward interest should do what every month? Decrease. And if we have taxes and insurance included in the payment, what do you think is going to be true of those numbers? They're going to be the same every month. They're going to be the same every month. So the balance on your loan should also be doing what after every payment? Decreasing. Does that make sense for everybody? All right. So let me pass this out, and we're going to start to work on doing some principal and interest math here. Number one says we're going to calculate the annual interest paid on a $175,000 mortgage. Okay, so it wants us to calculate the interest paid on a $175,000 mortgage which is issued at a 6% annual interest rate. Well, we know that that's just going to be pretty simple at this point, right? We're looking at this T-bar right here, annual interest over the loan amount times the interest rate. And the loan amount is how much? $175,000 times 6% annual interest. And what do we come up with there? $10,500?
Yes.
All right, so that's simple on number one, $10,500. All right, number two. Number two says calculate annual interest owed on a new purchase loan made at 80% loan to value on a $450,000 purchase. So let's talk about, we've mentioned earlier what a loan to value ratio is. What is it? It's the amount of the purchase price that the lender is willing to do what? To finance or loan, lend, right? So we need to know the loan amount here. We don't need to know the purchase price. What are we going to do to find the loan amount after we break the remote? What are we going to do?
Multiply 450 by 80%.
We're going to multiply that $450,000 purchase price times 80% loan to value or LTV. And if we do that,
360.
I come up with a $360,000 loan amount. How does that feel for everybody? Pretty good? Now, are we ready to calculate the interest owed for the first year on that loan? We would be if you gave us a rate, right? So pick one. Somebody give me an interest rate. 6%? I heard 6% first. All right, so just write in 6%. We're going to do it at 6%. So times 6% annual rate, $21,600. Fix that. All right, everybody good on that? Good with the idea of a loan to value ratio? All right, number three, calculate the monthly interest owed on the loan in question number two. Well, if we're going to do that, we would just take this and divide it by what? 12. So divide that by 12, and I come up with $1,800 a month. Feel okay about that? So $1,800 a month. Number four, calculate the monthly interest expense for a $215,000 mortgage at 5.25% annual rate. So what are we going to do first? What's first? $215,000 times 5.25%. And I get $11,287.50, but they want what? Monthly. That's annual, so we want to divide that by 12. We get $940.62 or 63 cents per month in interest on that loan. Number five just wants us to go to daily. So we have a $425,000 purchase price. But we don't care about purchase price, we care about what? We care about the loan amount. So what are we going to do with that loan to value ratio? We're going to multiply that purchase price by 80% to calculate our loan amount. So $425,000, 4.25 million, times 80%. I've got a $340,000 loan amount. Does everybody agree with that? Sorry?
So you wouldn't do 85?
No, why would I do 85? No, okay, I see what you're saying. The interest rate and the loan to value amount are two entirely different numbers. The interest rate is charged on the amount borrowed.
And they didn't borrow 100%, they only borrowed 80% of the 425, so that's where you got the 340 from.
That's correct.
Okay.
That's exactly right. They borrowed 80% of the $425,000 purchase price, so we come up with a loan amount of $340,000.
Okay.
And then we want to multiply that times the interest rate that's being charged on the loan, which
Which is
is
the 5%.
5% annual interest, exactly. And that gives us $17,000 per year in interest, but they want what? So we're gonna divide that by 360. $47.22 per day in interest on that loan. Now, number 6 is a little bit different question. It says calculate the accrued interest. Accrued, built up, accumulated. They all mean the same thing. Remember, when we pay a mortgage payment, we're paying interest for what period of time? The month before, right? And you're right, though, Faith, it's doing what? Building up on what kind of a basis every day? Daily basis. Is everybody okay with that? It's building up on a daily basis, but we're going to pay it all when we pay 1 month's payment. But what they want to know is how much interest has accrued as of June 18th. Well, when did the interest start accruing? On the 1st of what? June of that month. Because presumably on June 1st we made a mortgage payment that took care of any accrued interest from May and brought the interest back down to 0. Does that make sense? So as of June 1, should there be any accrued interest? No, and then it starts building back up on a daily basis. Does that make sense for everybody? So just what do you think we're going to have to do here? What do you think to figure out how much interest has accrued by June 18th? What do we have to first get to? We have to know how much each day costs. Does that make sense for everybody? We've got to know how much a day costs, and we've got to multiply that times 18 days because it's built up daily for 18 days. So let's get to a daily rate. We've got a $250,000 mortgage loan. And we're charging 6.5% interest annually, right? So, for the first year, we are being charged $16,250 per year in interest, right? Does everybody agree with that? What are we going to do with that number? Divided by 360 because I don't need yearly interest, I need daily interest. So when I divide that by 360, $45.14, I like that number, times 18 days, correct? So we've accumulated $812 and 50 cents in those 18 days in June. It is a lot. 18 days. 18 days at $45 a day. That makes sense for everybody so far? So that's accrued interest. When would that be a factor? When would we care about something like accrued interest in the middle of the month?
Prorating taxes.
Not prorating taxes, but how about just prorating? When will we prorate interest? When we're selling a house. Don't we normally close sometime in the middle of the month? Well, guess what? They're going to charge us interest all the way up to when? To closing. So, the last time we made a house payment was at the beginning of the month. So, let's say I close on February 15th. Well, I made a house payment on February 1, right? What interest did I pay with my February 1 payment?
January.
January's. but it started building again immediately, correct? So by the time we get to closing on February 15th, I don't owe that loan balance, I owe that loan balance plus the interest that is built up over those 15 days. Does that make sense? So here's a lesson for you. When you start talking to a seller about their loan payoff, their loan payoff's always going to be what related to that number that they see on their statement.
Change every day.
It's going to be more because every day it's going to increase by that daily interest charge. So when you look at that loan balance, that's as of their last payment. And every single day, do they owe more money? That's exactly right. That's the way this works.
How do they decide the first payment?
What do you mean, how do they decide the first payment?
You know, when you buy a house, you gotta make monthly payment, and then the first payment, because you said the interest is from the last month, right?
Yep.
There's no last month, they just bought it, you know what I
That's
mean?
right. So guess what? You're not going to make a payment the first month. If you close on February 15th, you're not going to have a payment on March 1st. When's your first payment going to be? April 1st. And what interest are you going to pay when you make that April 1st payment?
From the 15th.
Not from the 15th. You're going to pay what? March's interest. Just March. So what does that leave? Ask the obvious question.
Yes, and who pays that?
Who pays it? You do. When do you think you pay it? At closing. It's the one time you pay interest in advance. You pay for the remainder of that month, the day you close, and then you skip the next month and pick it up. So that you're correct on the interest payments. So if I close on February 15th, on that day I'm going to pay for interest from February 15th through February, what day? 30th. And then, when's my next house payment going to be?
April 1st.
April, which would pay March's interest. You okay, Sandy?
Not really.
Why not? What doesn't make sense about it?
Can you just repeat it again?
Sure. What part is confusing you about it?
Let's say you buy the house on the February 15th,
Okay?
and then March, do you pay the other 13 days?
You don't make a payment at all in March.
And then you make a payment on April, then
Yep.
you have to make like 45 days of.
No. You're going to only pay your regular payment, which covers what month's interest.
March.
Okay? So is there money you haven't paid?
Yeah.
You're going to pay it in advance at closing. Those 15 days that are missing, you're going to pay them in advance at closing.
Oh, so if you sell your house on the 15th too, so that means you gotta pay 30 days of. Because
No.
if you prorate it,
If you sell your house on the 15th, you're going to pay interest for those 15 days.
yeah, and then what you owe at the beginning too.
What do you mean, what do you owe at the beginning? You already made that month's house payment. If you're closing on the 15th, you already made a payment on February 1st, correct?
Yeah,
And that paid all the interest from January, right? I'm making a payment on February 1. How much interest do I owe? All the interest from January.
no, I don't think you understand what my question.
I'm not. I'm saying.
So if you buy a house, let's say this
Well,
year.
you keep flipping back and forth between buying and selling. Which one do you want to do? Because you've asked
No,
both
I
ways.
wanna just say the whole thing. So
You can't buy and sell the same house.
after you buy it and then you wanna sell it in like a few months, you can
That's
just do it,
two
right?
transactions, though.
Yeah, I'm trying to figure out like when you're gonna pay the interest.
And I'm trying to answer that, but I'm saying pick a side. You've got to pick, are you buying or are you selling?
No, I'm buying first and I'm selling.
You can't do two transactions at once. You can't. You do the front and then we'll answer the other one. I can answer it in two separate questions, but I can't answer two transactions in one question.
Okay.
So what do you want to know first? What happens when you buy or what happens when you sell?
Let's buy first.
All right. So what day are we closing?
The 15th
Of
February.
February.
Yeah.
All right. So when you close on February 15th, you're going to pay the interest on that day at closing for the remainder of February in advance.
Oh, okay.
Okay?
Okay.
And then you will not make a payment on March 1st because you don't owe any interest from February because you've already paid it in advance.
Oh, okay.
And then you will make a payment on April 1st because now you owe interest from March.
Oh,
Does that make sense?
yeah,
So you're right on schedule.
yeah.
Now let's handle the other transaction.
Yeah, you just prorate.
In September, when you close and you sell it, on the 15th, you're gonna pay for 15 days of interest, because interest has been building up every day since your last payment.
Okay. All right.
You okay now?
Yeah.
See, you gotta separate them. You gotta get them separate in your mind. Okay, yes?
So both buyer and seller pay days of closing?
Buyer and seller pay day of closing, assuming they both have what? A loan. Somebody could be paying cash, right? If they're paying cash, you're not gonna pay for it. But assuming they both have a loan, they both owe interest on the day of closing. Because the seller owes interest on their old loan and the buyer owes interest on their new loan. Now, when you love to be the lender on that one, it's the same lender going and coming, because you get paid interest twice on the same day. Does happen. Okay? We feel okay on this one? Yeah, go ahead, Nick.
What if you close on the 30th in a 31-day month?
What if you close on the 30th in a 31-day month? Well, if that happens, generally speaking, what they will do is the same exact thing. They're going to treat each month as if it has 30 days. Okay? And so the 31st, in essence, doesn't matter.
Okay.
They're going to simply prorate it till the end of the 30th, and that's it. And just like in February, you would pay for days that don't exist.
Right.
It comes out in the wash.
Okay.
Why do we, for daily interest, divide by 360?
Because it's called a banker's calendar.
Right.
And a banker's calendar makes every month have 30 days. Because if you think about it, in the financial world, it would be very confusing if your house payment had to vary by a day of interest, right? If your January house payment was more than your February, and then it went back up in March, and then went down again in April, because you had those days of interest floating around. So in essence, what ends up happening is that there are some months where you get off a little bit cheaper because you're only paying for 30 days worth of interest, but it has 31 days. And then, of course, there's February where you pay for 30 and there's only 28. But the idea is to just equalize it over the course of the year and make them all the same. Okay? All right. We are on number 7, right? Okay. So on number 7, calculate the payoff of a mortgage loan issued at 4.75% interest with a principal balance of $318,650 if the loan is paid off on the 20th of September. So, they owe $318,650 as of the beginning of September, correct? What are they asking us to do here? Come up with the payoff, and what's the payoff going to be? It's going to be the amount of the loan plus what? Any interest that has built up in September. So we've got 20 days worth of interest. So what we need to do is figure out a daily rate for interest, and then multiply that times what?
22.
Times 20, and then add it back to the balance amount. Is everybody okay with what we're doing there? All right. So we're going to take that $318,650 and multiply it times 4.75% annual rate. I've got 15,135 and 87 or 88 cents per year. And I'm going to divide that by what? 360. 4204 a day. Times 20 days. And that is $840.88 in accrued interest on that loan. That's how much interest has built up. Is everybody good on that? And then we're going to add that, so plus the $318,650. So that person is going to have to pay off $319,000. $319,490.88 is going to be that mortgage payoff as of the 20th of December. And if closing got pushed back a day, their payoff would go up by how much money? $42.04. They got pushed back. So for every day we get delayed in closing, the seller's got to pay an additional $42.04 in interest because it's an additional day of interest that they owe.
This 318 and 650 is the principal. How can you use that?
What do you mean, how can you use that?
You use, it's always the mortgage amount, now the principal amount. This is-
Principal amount, mortgage amount are the same thing.
So you're not talking about the principal and interest, like that's,
The principal is the loan amount. When we talk about the principal as far as the monthly payment, we're talking about the amount of the monthly payment that's being applied toward the principal. There's a certain amount of that monthly payment that's being applied toward the principal,
yes, right.
okay? So the principal is the amount you owe.
Oh, so this is the same thing with the mortgage loan, like previously you, what's like say $215,000 mortgage.
A $250,000 mortgage is a $250,000 principal amount. They mean the same thing,
Oh,
okay? That's why we try to change the terms up so that you get used to seeing them in all the different formats. Now, number 8. Here's where we get to the fun ones. And this is where the sheet is going to come into play for you guys, okay? So look at number 8. It says Travis purchased a home in Garner with a sales price of $175,000 and a 90% loan-to-value loan. What is the remaining principal balance of the 30-year fixed-rate mortgage after 2 principal and interest payments of $750 have been made on the 4.5% rate loan? It's a lot of information, right? All right, so first thing, we need to figure out how much money we actually borrowed. Would you agree with that? We need to figure out the loan amount. So what 2 numbers are we going to pull out of there to figure out our loan amount?
175 and 90.
175 and 90%. So we've got the $175,000 purchase price times 90% loan to value, right? And that gives us a principal balance of $157,500, right? So here's what I want you to do. On your little worksheet, I want you to start filling in the information. What does our balance start at? 157,500, right? So put that on line 1. And then just jump down to line 2. So don't put anything else on line 1. Just start at 157,500 in that balance column. Does everybody see what I got? It's up on the screen for you. Everybody see what I'm talking about? So put 157,500. That's your starting point. Now on line 2, how much of a payment are we wanting to make here? $750. So how many months do they want us to make that payment? 2. So go ahead and put it in there twice. Put 2 lines with $750. So you're kind of building out to see what you need to do. Does that make sense for everybody? So we're going to be doing it twice. We've got our beginning balance and we've got our $750 payment. Now, we don't have any way of knowing how much is going toward the principal. We do have a way of knowing how much is going toward interest, though, right? Can't we do that?
yes.
How would we do that?
157.5.
We can take that 157,500 and multiply times what? 4.5%. And what we find out is we're paying $7,087.50 per what? Per year in interest. So if we're looking at how much is going toward monthly interest in our little chart here, what are we going to do with that number? We're going to divide that by 12. So every month we're paying $5.90 and 63 cents in interest. Does everybody agree with that? So what am I going to do with that number? I'm going to put it in my chart. 5.90, 63. Now I'm not going to put it in twice like I did my monthly payment. Why? Because the interest is going to do what every month? It's going to change. In fact, the interest payment should be going which way every month? Down. So now let me ask you this. if I know how much my total payment is, and I know $5.90 of it is going toward interest, can I figure out how much is going toward the principal?
Yes.
Yes, I just do what?
Correct.
I just subtract them. So I'm going to do it as a formula up here, so to do the math is I come up with 159.37 going toward the principal. How do we feel about that number?
How did you do that? I'm sorry.
Our payment is a total of $750,
Right.
right? And $5.90 of it is
Okay.
interest, so that leaves the remainder going toward the principal.
Gotcha.
Okay? Everybody good with that? And how are we going to calculate our new balance over here?
Subtract the principal.
It's going to be the old balance minus the what?
Principal.
The amount going toward the principal. Does everybody see that? So, our new balance is going to be $157,500. This minus the amount going toward the principal. And so I come up with a new balance of $157,340.63. You guys see where that came from? No? So think about what you're doing. I'm making a payment of $750, right? What do we have to pay first out of that payment?
Interest.
So that means we got to calculate the interest first, right?
Yeah.
We did that, and we figured that the interest was $590.63. Everybody okay with that?
Yeah.
How much am I left over with after I pay $590? Think of a bag with $750 in it. I just took $590.63 out. So this is the amount that's left in the bag, correct? And that is going to be applied toward my what? My principal loan balance, which started at $157,500. So if I owed $157,500 and I paid $159.37 toward it, what am I left with? $157,340.63. No? You look scared and terrified.
I'm just wondering why you wouldn't, like, if you're gonna get the balance outside of the 157.5, why would you not use the 750 versus the 159.37?
Because I would love to do that, but the lender's not gonna like that at all.
Yeah, you're gonna be
Because
paying it, kids.
if they're not gonna take my whole payment and deduct it off my loan balance, because I owed them what?
Interest.
So I had to
This
pay
is a
the-
whole separate thing, like, it's
Yeah,
not,
that's-
they're not taking the.
Oh, no. That payment is principal and interest. So they gotta take the interest out of that payment first.
Okay, and the only thing they're deducting is the principal from the balance.
That's right. That's
Okay.
exactly right. I'm not paying that loan down by $750 because I make a $750 payment. I'm only paying it down by what's left after I pay the interest first.
Okay.
So I gotta pay this $590.63 first. So when I send my check in for $750, they're gonna first deduct the $590.63 out of it.
What's left they apply
And then
to
what's
the balance.
left, which is this amount, gets applied toward the balance.
Okay, I got
That's why it
Following-
takes 30 years to pay off.
That's why it takes 30 years to pay that thing off, right?
you. You're right.
So that balance after my $750 payment only comes down to $157,340.63. Now, how many payments have we done? One. How many do they want us to do? Two. So we got to restart the process. The only thing that stays the same is what? The monthly payment amount. That's $750. We have to recalculate every other number. Every other number is going to change. It's going to be different. So what do we start with?
157,340.
What's the first thing we have to calculate?
157,340.
What do we pay first? We pay the interest, so we gotta calculate the interest first, right? Alright? So, to calculate the interest, we're gonna do 157,340, because that's the amount we owe now, right? And how much was it? 63 cents? And what's our interest rate? 4 point, how much? 5. 4.5%. So if I do that, I get 157.63 times 4.5%. I get how much?
$7,032.
Is that 7,080
Yes.
and 33 cents? Okay, in annual interest, right?
Yes.
33 divided by what?
12.
Okay. 590 and 3 cents. 590.03 in monthly interest in month number 2. Does that make sense? Now, if I go back to my chart and I fill that in, 590.03. What do I notice? The interest did what? It went down, right? Isn't that what's supposed to happen? It's supposed. And the reason the interest went down is because we owed what? Less money. We're paying interest on a lower balance, so there should be less interest to pay. But we're still making a $750 payment, so the principal is going to be $750 minus that $590.03. So the principal went up to a whopping $159.97 in month number 2. And my loan balance is going to be my balance from month 1 minus, right? So 157,340 minus the new principal amount, which is 159.97, and a new loan balance of 157,180 and 66 cents. Could you keep calculating it for 3, 4, 5, 25 payments? If you had a lot longer than 4 hours on the exam, you could, right? 2 is about the most they'll ever ask for. 60 cents. That's how much it came down.
When would someone ask us to do, like, you know, when would we do this, like, when we're out in the...
You wouldn't. You wouldn't. But you're expected to understand it. But now, would accrued interest be expected in the real world?
Yeah.
Think if you're sitting down with a seller and you get a delay in closing, don't you need to be able to quickly tell the seller how much more money they're going to have to pay off, how much the payoff would change if you get a 5-day delay in closing? You could figure the daily interest rate and then multiply times 5 and say, well, it's going to cost you an extra whatever.
Okay.
And for example, on this one, if this closing got delayed by 5 days, I would take 590.03, right? Because that's how much interest I'm paying this month, right? Divide it by 30, which is $19.67 a day, so times 5 days, I would tell the seller it's going to cost you $98.34 for this 5-day delay. That's a real world scenario right there.
Okay.
I feel, does the little chart help you keep it assimilated? Now keep in mind, on the test, you will not have the little chart, so you need to get in the habit, but can you write it out? Can you just write total payment, principal, interest, taxes, insurance, and balance? It's not that hard to make one for yourself on a piece of scratch paper, right?
You get scratch paper?
You get all the scratch paper you can use. All the scratch paper you want. So you can make yourself your own little chart for it. I think it helps to keep them in line. Here's what I really like doing. Whatever number of payments they're asking you to make, here's how you always start. You always put your beginning loan balance in the top right and then skip down to the next line, and then whatever number of payments they're asking you to make, fill in that payment that number of times. If they're asking for 3 payments, I would have put $750 in there 3 times. Because it's clear to me that I'm not finished until I've filled in those 3 lines. Does that make sense for you guys?
Mm-hmm.
Why don't you go ahead and do it for one more payment? Even though the question said 2, go ahead and run it for a 3rd payment. And I'll blank it out and do it, and then we can check your work. Try to reassemble the note. Ready? How you feel about that number? $157.20.09. $157,020.09. Feel pretty good? Does it give you some confidence now? And you're like, it seems intimidating at first, right? It's really not. It's more just about getting things lined up in your brain. It's like, okay, I'm paying the interest first. I got to calculate the interest first. All right. So then let's look at number 9. Number 9 is really the same question. The only thing that's different here is the fact that we have added in a complication. What's that complication? Taxes and insurance. This is called escrowing. Your lender, most of the time, wants you to not have a big tax bill at the end of the year. Why? You might not what? You might not pay it. They don't trust you to pay it. So they tell you, we'll help you out. Why don't you just send us your taxes on a monthly basis and we'll keep it in a nice little escrow account for you. And at the end of the year, we will pay your taxes. They're really doing it to protect who? Themselves. Why the insurance as well? They want to make sure what? The house has insurance in case it catches on fire or you have a hurricane or a tornado or something. Does that make sense? So, the math here doesn't change. We still, though, have to look at that payment as being broken down into pieces. Instead of just a PI payment, we now have what we call a PITI payment. A pity payment. Principal, interest, taxes, and insurance. So here's the way I want you to think of it. First, we always pay the what? Insurance, the interest, right? When you talk about a monthly mortgage payment, the first thing the bank's going to do is pay themselves. So they're going to deduct the interest. Then they're going to deduct what? The taxes. And then they're going to deduct the insurance. And what's left over after all of that comes out is the amount that they're going to apply toward the principal. So that's how we're going to approach our chart. We're going to do the same thing. We just have more pieces to break out. So what they tell us in number 9 is that we have an initial loan balance of $325,000. So that's my starting point. And I know that my pity payment is how much? $1,600. And how many of those do they want me to do? They just want one, right? So that's the only, I'm going to put it in there one time. They only want one monthly payment. All right. So what do we always pay first, and therefore what do we calculate first? Interest. So if I go over here to a blank screen, we want to calculate our monthly interest. We have an initial loan balance of $325,000 times 4.25% interest. All right, 325 4.25%. I get $13,812.50 annually. Yes. That sound familiar? Yes. What are we going to do with that?
Divide by 12.
Divide it by 12 to get it down to a monthly amount. And it looks like to me we've got $1,151.04 per month. Everybody okay with that? $1,151.04? All right. So if I go back to my chart, I'm going to fill in $1,151.04 in interest. Now, I need to calculate how much of that payment is going toward taxes and how much is going toward insurance. What they tell me is that we have an annual property tax bill of how much? $36.24 per year. What do I care about? Monthly. So what am I going to do with that? I'm going to divide that by 12. So we got how much? 302?
Yeah.
302 a month going toward property taxes. So I go back to my chart and I'm just going to put 302 in taxes. And we also need to figure out the monthly insurance amount. And what we know about that is we're paying $612 per year. $612 per year, so I'm gonna divide that by 12. 51 bucks per month. And I'm gonna fill that in my chart. Now, if I know that my total monthly payment is $1,600, and I've calculated the interest, the taxes, the insurance, can I calculate the principal now? Can I figure out how much money's left over?
Yes.
So I'm just gonna subtract all those out. I'm gonna take the interest out first, so that 1,600 minus my interest, minus my taxes, minus my insurance, and I come up with a whopping $95.96 going toward my principal balance in that first month. Isn't that lovely? That's beautiful out of $1,600, isn't it? Welcome to the wonderful world of a 30-year mortgage. So to calculate the balance, it's just going to be my beginning balance. My beginning balance minus my what? Minus my principal payment. And I paid it all the way down to $324,904 and 4 cents. Why don't you do this? Go ahead and calculate it one more month. So what numbers can we immediately bring down to the next month to save ourselves some math?
Insurance.
Insurance is going to be the same thing, taxes is going to be the same thing, and the monthly payment is going to be the same thing, right? So those numbers are already filled in, which means we need to work on what first? Interest. All right, you guys go for it, and we'll blank it out. Go ahead and calculate after one more payment. Remember, just kind of a self-check of yourself. Your interest payment should be going which way?
Down.
Down. Your principal payment should be going up. So when you fill your chart in, look at those two numbers and make sure they make sense. Ready? 324, 807, 74. How do you feel about that number? I mean, you might not feel good about it, but did you get it?
Yeah, I
Did
got it.
you know, you might feel sick looking at it, but I mean, you paid a whole $96.30 this month toward your principal. That is a very realistic, by the way, 30-year amortization schedule. It is a very realistic one. It takes a long time to get to the point that that principal number is bigger than that interest number. very long time. Remember, that's the downside of refinancing. When you refinance, what do? You reset back to that year one cycle.
Can
Where,
I choose 15 years? It has to be 30 years?
I'm sorry?
Can you?
You can do 15, you can do 5, you can do any term. The most common is 30. By far the most common. And why do you think that's the most common? Because it's the lowest what? The lowest payment. The lowest payment. And people are trying to maximize affordability, so they do that by minimizing payment.
Isn't that so much better just with cash though?
Of course, everything's better with cash. Cash goes better with everything. But you have to have it first. You have to have it. Okay? How we feel about these? Good, good, good. This is a concept that people have traditionally struggled with. I think doing it as the little kind of, the little chart helps, the little spreadsheet helps there. Just remember you won't have that, so get used to, as you practice on these problems, just draw your own. Just, so you get used to kind of drawing your own out. I think you can kind of get rid of the chart after a while too, because you start to, mentally you're processing what you're doing. But the chart gives you a nice little visual representation of it until you get comfortable. All right, we'll do number 10, and then we're going to take lunch, okay? So let's look at number 10. On number 10, it says that we want to calculate something called the interim interest. So I want you to put in your notes here, interim interest, what it is. Interim interest, remember we said if you purchase in the middle of the month, you've got to pay that first portion of a month in advance. Remember we had that discussion earlier? It was one of Sandy's questions, all right? Interim interest is that first portion of a month that you're paying in advance. So if you look at this question, it says calculate the interim interest payment for a February 20th home purchase in Cary. So, interim interest is going to be from the day of closing till when? Till the end of the month, right? It's the exact opposite of accrued interest. Accrued interest is from the first of the month through the day of closing, and that's something the seller would pay. Interim interest is from the day of closing through the end of the month, and it's something who would pay? The buyer. Does that make sense for everybody? So, when you look at this question, before we get into the math of it, I want to talk about how you're going to make this silly mistake. Okay? So I'm going to ask you to answer just one portion of it. I want you to write it down, and I'm going to walk around and look at your answer. I want you to write down, so interim interest in this case is going to start on the day of closing and go through the end of the month. I'm going to help you out here. What's the day of closing?
20th.
February 20th, right? And what's the end of the month? February 30th, right? So I want you to do me a favor. I want you to write down on your paper somewhere in front of you so that I can take a glance at it, how many days there are from February 20th to February 30th. I just want you to write that number down in front of you. No, sir. Yes, ma'am. No, sir.
No?
From February 20th through February 30th. No, ma'am. Doesn't answer? Yes. No, ma'am. See why I have to do this? No, ma'am. Yes. No. Yes. No. Yes. Got it. No. This is why you have fingers and toes. What day we starting on? 20th. 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. How many days is that?
11.
That is 11 days. It is not 10. I'm sorry?
I have 11 days and you said no.
Oh, I said no? I'm sorry. Jeez, you caught up on mom.
Gee,
11 days. You got to count the day of closing, right? Don't just do 30 minus 20 is 10. It doesn't work that way. Okay, you can't do that. So whenever you're counting from middle out to the end, you've got to add a day for it, right? I suggest just counting with your fingers or making tick marks on a page so you don't make that mistake. Because it's 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. It is 11 days.
But when we're calculating accrued interest, do we not include that day as well?
In accrued interest, you include that day as well. So if it was accrued interest, how many days would you be using?
20.
You would be using 20.
So there's an extra day.
There's an extra day. Because who pays accrued interest?
The seller.
The seller. Who pays interim interest? The buyer. So what we mean is they're overlapping on the day of closing. The day of closing, both lenders are going to get paid for.
They pick up the full.
Seller's going to pay interest through the day of closing. Buyer's going to start paying interest on the day of closing. That day overlaps. That's why the math doesn't work. Because you're not actually prorating it between the two. It's two separate loans. The only time you would do it the way you're talking about is if it was an assumed mortgage. If it was an assumed mortgage, then it would be 10 days because they would pick it up with the next day. Does that make sense? But when you're talking about a new mortgage loan and interim interest, you got to pay for the day of closing.
You're not gonna do that too.
They are absolutely going to do that too.
No, I'm not talking about that.
Oh, if it was assumed? No, you'll never see it with an assumed. Okay? Is everybody okay with this? So, on this question, when we're calculating interim interest, the big key to getting it right is to do you think there's going to be an answer choice that lines up with you doing it 10 days? Yes. Yes. You got to do it for 11 days. So what are we going to do on this thing? 480 times
4.25%.
Yep, so $480,000 becomes easy after this, 4.25%. That is $20,400 in annual interest, right? Divided by what?
12.
Not 12.
360.
We want daily, right? Interim interest is going to be based on daily because we want days of interest. So we're going to divide that by 360.
56.67.
That is 56.67 per day times 11 days. And that is going to be an interim interest charge. So that's the interest paid in advance by the buyer, $623.33. 32.33.
And that's what you call interim interest.
Interim interest. So give me a definition of interim interest. It is interest paid by the buyer from what day to what day?
On closing.
Day of closing till the end of that month. So please don't do interim interest and calculate like 45 days. There is no month that has 45 days from the day of closing till the end of the month, right? Interim interest is either interim or accrued interest is always going to be less than 1 month. It's always going to be a portion of a month. Accrued interest is going to be the portion from the beginning of the month through the day of closing, right? And interim interest is always going to be from the day of closing through the end of the month. Accrued would be paid by the seller. Interim would be paid by the buyer. Okay? How we feel? Pretty decent? Alright, let's take lunch. Yeah, you round up pennies. It's not gonna matter because they won't give you an answer choice that rounding's gonna matter. Yeah, you don't have to worry about that. Okay? Even if you're off several cents, you'll be fine. Okay? So let's come back at 145. Yeah, I'll bring you one.